There we go. And we're recording. Perfect. Okay, so just a couple housekeeping things. So as long as I was talking about it before we started the live recording, I did spend some time in the past week on the website. If we go to the new website, for most of you, it's the same website. It's just new for me, newer. In products and programs, and because a lot of people ask me this, like, where do I go to find out what you're doing and when? We have a live events page here. And what I did recently was I really filled it out with like everything that's going on at Nerd Enterprises. So now it includes the twice weekly 97 and up calls. That's of course only available to people who are in 97 up. If you click on one of these, I'll give you the information. This is the page you can go to sign up for 97 and up, and then you'll be able to get on those calls. But then you'll see, and you can tell by the color coding, the blue is the Bulletproof Bookkeeping webinar. So that's every Wednesday from 1 to 2 Pacific. And this will adjust based on your time zone. If you're on the website, it can tell from your IP address where you're located, and it will give this to you in your own time. And then this is the Friday one. So the green is the Zoom in with Seth. That's the Friday webinar that we do. So I've got it pretty well sketched out. I have to update more Bulletproof Bookkeeping ones. For now, I've got placeholders that will just say topic to be announced, right? But it's still always every week, same time. And then the fourth Wednesday of every month is the one that's only for people who've signed up for the Bulletproof Bookkeeping course. That's the Q&A we do once a month for everybody, so that as people are going through the course or working on clients, you form questions, you can ask those questions and we give you the answers. And then those recordings get posted up in the course, again, for members only, so to speak. So today I wanted to talk about inventory valuation. This is inspired by a situation I had recently with an actual client, and a lot of these, that's kind of where that comes from. So what I want to do is, let me bring up the QBO test drive company. Apparently I can't type today. And then I also want to bring up a spreadsheet so that we can play around with some numbers. And I'll share my screen again. Oops, I clicked too fast. I hate that. You have to wait. I'm not a good waiter. I don't have patience. All right, let's move that out of the way. Okay, so let's first of all talk basic inventory workflow. Okay, the basic formula that they teach you in Accounting 101 for how to calculate inventory is we have beginning inventory plus purchases, right? Let's put that actually in, plus purchases less cost of goods sold equals ending inventory. And it's important to remember that when we talk about cost of goods sold, we're talking about very literally the cost of what was sold, meaning this is driven by sales, right? So this is where a lot of clients who don't really understand accounting get very confused. And this is good for you to think of when you're trying to explain this stuff to clients, that a lot of times when I say, okay, well, we have to look at sales to see how many units were sold over a period of time, they're thinking sales, they're thinking at their retail or whatever they sell it for. And so we often have to remind people that cost of goods sold is simply the cost of what was sold. So we have to look at the sales, but not for the amount we sold it for, but for the cost, which has hopefully everybody here by now knows. QuickBooks Online calculates your inventory cost on a first in, first out basis, right? And I've got some videos. If you want me to send you the link, just reach out to me after the webinar. I can send you the link, but videos that walk you through very sort of comprehensively and sequentially exactly how QuickBooks Online calculates cost of goods sold on this basis. I basically walk through an example where we have a product that's been purchased at different prices. I show you in a spreadsheet how to calculate what the cost is of what we've sold as it crosses over the different pricing tiers based on the different prices we bought it for, and I predict what the cost of goods sold is going to get calculated to be. Then we go into QuickBooks Online and I show you how it actually arrives at the cost of goods sold number. It's not what we're used to with QuickBooks Desktop, where it's weighted average cost, right? So if let's say this is day one, year one, day one, so we start out, we have 0 inventory, right? And let's say we buy $100,000 worth of inventory. Okay, we'll start there. Let's format this stuff to look like numbers. Okay, ending inventory is going to be, again, beginning inventory plus purchases less cost of goods sold, right? So if we start out with nothing, buy 100,000 and we don't sell anything, we're going to be left with 100,000. So remember, the cost of goods sold number is always in terms of cost. So let's say over here we sold 100 units, right? At, I don't know, $100 each, right? Units, price, total, 100 times 100. Okay, but again, this is not the cost of goods sold. This is what we sold it for, right? So the COGS on that is 100 units, and let's say it costs us 50 bucks, right? So this is going to be our cost of goods sold on something like that. So now that we have that over here, we can say less 5,000 means we're, of course, left with $95,000 in ending inventory, right? Very, very simple, straightforward math, right? So this is how we get to the ending inventory number. But what I wanted to talk about, and the reason I wanted to go to the trouble of illustrating this very specifically and clearly, especially in terms of the number of units, is let's say today is April 29th, okay? And we need to figure out what was this number, ending inventory, as of December 31st of 2019. So the first thing we're going to do is say, go take a count. Let's say they count it. Let's say a miracle happens and it's perfect and they count it and it all adds up exactly to the 95,000 that we show here, right? Again, this is as of April 29th. If it doesn't agree, then obviously we have to make our adjustment first, right? So we adjust inventory based on the count date and make it equal 95,000. Of course, when we're doing the adjustments, we're doing it by SKU and adjusting for the quantity. And QuickBooks Online, all you have to do is really adjust the quantity and it figures out how to adjust the value from that, right? In QuickBooks Online, we're going to go new and we're going to go inventory quantity adjustment. And so to post the adjustment, of course, you add as many lines as you need. You'll pick your SKU, right? And it shows you, this is just like desktop does, it shows you the quantity on hand now. And you can either tell it the new quantity or you can tell it the change in the quantity and it will back into the new quantity, right? So if we counted this and it turns out we had 3 of them, then we can put the new quantity of 3 and it's going to add that change in quantity, right? It's going to figure that out. Now, of course, here we have to tell it, where are we adjusting this to, right? Obviously, the one side of it is going to be to the inventory asset, right? That's the natural, starting point of this. But so if we're increasing inventory, as we are in this case, then we're increasing the inventory asset. So this is going to result in a debit to the asset account for whatever the value is. The credit is going to go to whichever account we put here, right? So some people will just put it straight to cost of goods sold. Most of us, like Elaine and I were discussing before we went live, we're going to put an account. By default, QuickBooks often gives you an account called inventory shrinkage. I personally prefer to be very literal and call it inventory adjustments. Okay, and this is going to be a cost of goods sold type of account, right? And it should be just the supplies and materials. It doesn't really matter for the detail type, right? And then this way it's very straightforward. And the reason I like to call it inventory adjustments, besides the literal nature of it, is just like we would use shrinkage, but I think shrinkage just throws people off. A lot of business owners don't really understand the word shrinkage. It's a commonly used term in retail. But it's just inventory adjustments is so much more straightforward. And then if I'm running a monthly profit and loss, I can look at that line item. And assuming I know when the counts have been done, which months they were done in, I can look at the trend and see if my inventory adjustments account is constantly being adjusted upwards, then that could suggest the problem, right? It could suggest that somebody is walking out of the warehouse with inventory. If we're constantly landing on having less inventory on hand when we count it than what the books show, that it doesn't necessarily have to be that it indicates that, but it could be an indication of that, right? So I look at this as almost like part of the system of internal controls. I look at this as a way of gauging, is there a problem that we need to take a closer look at, right? Maybe we need to tighten up our inventory controls to make sure that nobody is or can be walking out with inventory. So that's how we do the adjustment. The adjustment date, of course, should be the date that they took the count. In a perfect world, you're able to tell them not to post any sales or purchases of inventory on that day, because otherwise you're trying to adjust for an account and count a moving target, right? So usually that's part of the process. When they take inventory, we tell them halt on, if you have orders coming in, just let them sit on the loading dock for the day until we finish counting what's already in. That way we count what was truly there, and then they receive in the new inventory, and that's going to happen post-inventory adjustment, right? So we book that the following day so it doesn't screw up our inventory count numbers, right? So these are important sort of physical logistics to think about when you're doing this stuff and working with a client on it. So what we want to do now is, if we got them to count it, and let's say they counted it, and let's say it came out to the 95,000, now what we need to know to get back to the 1231 inventory is we need to basically reverse this process, right? So to get to the 1231 ending inventory, what we have to do is take the 95,000 that we have today, and let me just fix that. And what we have to do is we have to subtract out any purchases that were made between January 1 and today, right? So minus purchases. In this case, it's all purchases, because remember, I started us off purposely to keep the numbers easy. We started off with zero inventory. So the purchases from January 1st until today in this scenario would have been the exact same thing, right? So it would be minus 100,000. Otherwise, you'd have to go into QuickBooks and run some reports to see how much, where are all the bills that represent all the purchases of inventory during this time, right? So we have to subtract out the purchases, and of course we have to add back the cost of goods sold. Now, in theory, this needs to be done in units, right? So let's fix that, because what did I say? So the unit price on the cost side is $50 each. So if we're starting with 95,000, this really needs to be in units again. So we'd say 95 divided by 50. So we have 1,900 units that we have on hand as of 12/31. Okay, we have to subtract out the purchases again in units. So I'm going to divide that by 50. And again, this is a very simple model, because we're assuming all the inventory was bought at the same price, and we're assuming either that it's just one SKU or all the SKUs at the same price, right? So I'm very much oversimplifying this. The schedule you're going to have to do is going to have to break down cost of goods sold by SKU, so you can figure out the number of units that need to be adjusted for, to backtrack from today to December 31. So if the cost of goods sold, if what we've sold is 5,000, we have to add that back to inventory, right? Again, in terms of units. So we would say, take negative of that, right, divided by 50. So we're adding back 100 units, and that checks out. That's exactly what we sold, okay? So now the ending inventory as of 12/31 is simply the sum of all of this. Which again is 0, which checks out to what we know to be true based on the scenario I set up, right? So again, it's normally not going to be this simple, because normally you're not going to be doing this in year 1 of a company where the inventory started at 0. I wanted to keep the numbers simple so you could follow the concept, right? Because then once we have the number of units in ending inventory, and of course, again, so you have to do this kind of analysis for each SKU, to do this right. And then once you have this ending inventory number as of 12/31, then you go back to 12/31/19, go into the books, and you run what it says the inventory was. So it's just as if you took a count on that day. You're running what it says the inventory was on 12/31 and making an adjustment to get the books to reflect what really is in ending inventory, which in this case would be 0. So if there was any inventory indicated as being on the books as of 12/31, in this case, we would just book the entry to 0 it all out. So if it says quantity on hand 2, we just change the new quantity to 0 and do that across the board for every single item. And to see what's on hand as of a given date, there are inventory reports that you can run in QuickBooks Online that will give you that exact information. So I just duplicated the tab so I don't lose my place in the adjustment screen. And you can use the search, and if you start typing inventory, you'll get them. And what we really want is the inventory valuation summary. And so this shows me the inventory items I have, it gives me the SKU, and it shows me the quantity on hand as of today. But if I back this up to December 31st, you'll notice it will update. In this case, there was apparently nothing on hand as of December 31st. So let's go over to January. I forget what these sample books sort of have in terms of what activity is on what date. It looks like maybe just the last couple months. Nothing as of March even. All right, so again, in this case, it's oversimplified. But mainly, like I said, I just want to make sure that everybody has the concept of how to get to this. You'd have to do this for each SKU. Again, this would come from the count, right? You'd know what you started with on hand. That's when you run the valuation report as of today, what you started with. Then you take the count, and the count is going to get you this number, what the ending inventory number is, right? In between, it doesn't matter. We're going to back into things because if we take the ending inventory here and say, okay, well, we just count the inventory and really it's just 90,000. The difference is going to go to cost goods sold. Like I showed you earlier, we'll have a separate cost goods sold account for inventory adjustments, but ultimately that would cause the total cost goods sold number to increase by another 5,000, right? And if we did that, of course, what that would suggest is that the ending inventory had the 100 units still on hand, right? So when we then back into it, remember I had made all this sort of relative. So we back into it, assuming 90,000 ending inventory after we count it today, that means we should have theoretically started with 100 in inventory as of the beginning. Really what that means is there's 100 units worth of shrinkage that disappeared based on $5,000, right? 100 units at cost is $5,000. So we changed the cost of goods sold by $5,000. That's where this is coming from, right? So any questions? No? Elaine, does that help clear up kind of what you need to do with your client?
Yeah, something I'd have to look at again, but like I said, this is a webinar of interest for sure. Yeah, it's a whole interesting scenario.
Right, right. Yeah, I mean, at the end of the day, if you don't have a good starting point, you have to make that starting point based on whatever day you can take a count, right? And then hopefully, if it's not too bad, you can take that count as of today and just roll forward. That's normally, hopefully the case. But like I said, a lot of times, at least the first year that we're working on a client, we run into this scenario where we have to then back into, okay, so what did we have on hand, 4 months ago, 5 months ago, right?
Mm-hmm.
And this is the way you have to do it, what I've just outlined. You have to take today and you have to back out all the purchases by subtracting them out of inventory. And you have to back out all the sales by adding those back into inventory. It gets people twisted because it's like sort of backwards, right? So when I start saying you have to add back the sales, because sales result in deductions from inventory, right? When I sell something, I'm reducing inventory and moving it out of the warehouse and into the hands of the client, right? So that's why sales have to be added back and purchases have to be subtracted out, because we're backing up to a point in time before we made those purchases, so we didn't have those items on hand, so we have to subtract them out. And so this is where people get really tripped up. But what I've always done when I've had to do this is again, today I gave you the very simplified version, but what I'll do in a real scenario is I'll share my screen again and show you kind of how I'd start building the analysis out. Let's go to the inventory valuation summary, and let me just dump this into Excel. So the way I laid it out, we're going to kind of transpose this, right? Let me just clean up some of the junk here. So here we have it laid out by SKU. So we're going to, and this is the quantity on hand, let's just say as of today, as of April 29th.
Mm-hmm.
So to go back to December, what we need to do is take the quantity on hand as of today, and we have to add back sales, right? And this is going to be from 1/1/20 through 4/29/20, right? So we have to add back all these sales in quantity. I hate when it does that wrap text thing. Let me just fix that real quick. Boom, boom. Okay, and then for the same period, we have to subtract purchases. The real challenge is getting the numbers that belong on each of these rows for each of these SKUs. We have to run reports to see, and it's not that hard to run the report because I can go through each SKU, and if I tap the quantity right off this report, it'll give me the whole history.
When you run it through inventory, whatever, through your products and just run the report, then you can see how many sales you made, right?
Yeah, exactly. So right here you can see, notice the bills are additions to inventory and the invoices are subtractions from inventory, right?
Mm-hmm.
So we can dump this into Excel and just kind of split it up and say, here are all the purchases. And a check is really just like a bill. It's just we wrote a check to pay for the inventory. Bottom line, a positive number means an increase in inventory that happened during the time period. That's what needs to get subtracted out. And so it looks like our starting value is 16 as of, well, April 3rd is when it looks like this was set up. But so this is how you would extract the numbers you need to fill in. Where'd it go? Oh, that's right. It's in Excel. I hate Excel. I don't really hate Excel. But you'd add back the sales. So let's start with that. So on the pump, is that what I looked at here? Yeah, here's the pump. So our sales are actually just 2. Okay, so let's add those back. Okay, and then we'll subtract out the purchases, which is, let's just call this a purchase because we're just adding it onto the book. So 16 and 3 is 19 and 8 is 27. Keep doing that. So we're going to subtract the purchases, so minus 27, and that's going to get us 12, 31, 19 inventory. Okay, and this is going to be the 25 here, right? Plus the sum of what we laid out here. Okay, and it zeroes out because we've, again, as we saw in the report, we've accounted for all the activity that happened entirely in the month of April, right? So it makes sense that that would get us back to 0 because we've accounted for everything. If I assume that the 16 was, not something that was purchased during this time, then I would simply remove that from the equation. So the purchases would just be 11. And that, of course, would get me back to that beginning inventory balance of 16, right? So once you have this concept down and layout done, it actually gets very easy because now you're just basically filling out a form, right? For each SKU, we just need to go into that quick report, look at the activity, pull out what were the sales, what were the purchases. And in theory, you could just do the net of it, right? I could just do 25. If it's positive, then that's net purchases or something like that. Because originally we had negative 27 in here. So I could just put net negative 25 and it would have the same thing. But again, this is bulletproof bookkeeping. I always want to be prepared to have to explain how I came up with my number. So this breaks it out and makes it a lot clearer that I'm adding back the sales and subtracting out the purchases from January 1st through April 29th. So again, taking the extra time to lay it out like this makes it super clear if I have to present this to somebody else, such as a skeptical business owner who thinks I'm screwing up his inventory, right? I always kind of operate from that assumption that at some point my business owner client is going to accuse me of screwing it all up, and I have to be able to prove him wrong. That's kind of the approach I always take on this stuff. And
Can I? Oh,
go ahead.
I was just going to ask, can I just confirm, you have to create a purchase order before a bill in order to get it into the inventory. Is that right?
No, you can go straight to creating a bill. You don't have to have a purchase order.
And it will put it, If you create a bill, it will put it into the inventory?
Yeah, in fact, even with the purchase order doesn't put anything into inventory. It doesn't get into inventory until you've converted that purchase order into a bill.
Into a
So it's
bill.
creating the bill that actually posts to inventory. A purchase order is non-posting.
Right.
So
I
you don't.
just thought you had to do it that way. I don't know why.
No. I
Okay.
mean, a lot of people do because we want to track, especially if there's a lag between the time when we place the order of the inventory until we actually get it. That's when you definitely want to use a PO, but
Mm-hmm.
you don't have to if you go straight into.
Okay.
And if you're ever wondering, all you have to do is test it, right? So if I go in, I'm going to enter a bill to buy a pump, right? So I don't know who the vendor is for this, but we'll just pick somebody. Okay, we go into the item details. We'll buy a pump. Looks like one of them costs about $10, right?
Mm-hmm.
And so this is going to be dated 4/29. Let's back this up to like January 1st. That'll be fun. What did I do wrong? Select the transaction date that comes after. Oh, yeah, this is the annoying thing about when you set these items up and it asks you for the starting date of that inventory item. I always backdate the heck out of that so that this doesn't happen. It's so annoying. It doesn't do me any good. It just gets in the way. So let's see if it'll let me do it as of like February 1st. Nope. So to figure out what's actually going on here, we have to look at that date where it had the 16 units that were transferred on.
Mm-hmm.
That was clearly the starting date of the item. Let's go inventory, and it was in April, so that's going to be the problem. Inventory valuation detail on the pump. Yeah, so this is when we see number says start, and you only get one shot at this. I don't think it'll let me change this, but even if it does, either way. Well, let's see. Let's change it to January 1st.
Yeah, I don't think you can.
Yeah, you can. Oh well.
I've fought with it before. Yeah.
It's so annoying. All it does is create friction for no good reason that I can think of. Anyway, so this is going to have to be dated in April. And then as you'll see, it stuck my bill in there.
Purchase. Yeah. Okay.
Wait, which one was it?
It was Sig's Health, the last one. Cigna.
Oh, I did it for the 16th. That's right. I did one
Yeah.
bill for that. Yep.
Mm.
That was it. So normally, I guess we get it from Norton Lumber and Building or Hicks Hardware. So anyway, so now you've confirmed it that entering a bill will definitely increase.
Would increase. Okay. Cool. Thank you.
Yep. And I'll just delete that. So this is what you have to do. The challenging part is not this one. This one. The challenging part is then filling in these details. But once you have it filled in, you have a beautiful worksheet. And then this is going to be and then of course you have to get the valuations, right? So when you run the reports, it gives you the calculated average cost because it would be very difficult to run a report that shows you all the tiers for the first in, first out cost. So they do give you the calculated average. So you could use that to adjust the valuation. So you just take the inventory on hand times the calculated average, right? And you can copy that over so that as you adjust these numbers, you'll know what the value should be. But again, when you go to QBO, you're just going to post the inventory quantity adjustment. So this is all you really need is the units. And like I said, QuickBooks will figure out the valuation. If for some reason your valuation is ever like way off on an item, then what I do is I create one inventory adjustment to zero it out. And then I create another inventory adjustment to put it back on the books. Sometimes that still doesn't work. So if all else fails, what I will do is I'll create a $0 bill. And I'll show you what this looks like. So I put in the pump here. And I say, okay, what's the quantity on hand for the pump? Right now it's 25. So let's date this today. Okay, and we're going to say minus 25 of these, right? And we're just going to zero them out. So 25 of them comes at a cost of $250. When I compare that to the value on the report, that checks out. And let's say now I want to add them back in because really I've figured out that they should come in at a rate of $15 a piece. right? So it's a $0, it's going to be a $0 bill, but there's one more thing we're going to have to do, right? Because I'm subtracting out the inventory value at 250, I'm adding it back at 375. The difference of 125 is going to have to go up here to your inventory adjustments account, right? There's nowhere else to put it, so you have to run any difference like that through cost of goods sold. If the valuation was off, the natural offset would be cost of goods sold. It means cost of goods sold had to be off. So this is actually fixing that piece of it, right? The only way to adjust the total valuation on the inventory is to push whatever the difference is through cost of goods sold. So let's save this. I need a vendor. It was Hicks Hardware was one of them, right? Perfect. Save it. And let's check my report. Refresh it. That's weird. Just do all dates. Boom. See how that worked? It zeroes it out, adds it in at 375. So if you need to do an adjustment to the valuation, that's how you have to do it, is
It's
with
a
a
nice
zero.
way.
That's pretty slick, right?
Yep.
So that's how you do it. You just, on the same day, you zero it out, add it back in. And like I said, the difference of the valuation has to go to cost of goods sold. There's no other natural place to put it.
Okay.
All right. Everybody else has been quiet. Who else? We just added a new participant right as we're ending. Jesse, how are you?
Good, good. Yeah, I'm pretty inventory literate, but I do have a
Inventory
cleanup
literate or
job.
inventory illiterate?
Illiterate,
Okay.
definitely illiterate. um, like I got a client like on the cleanup job, and I mean it makes my job a whole lot easier, at least for the cleanup job, but not for going forward. I don't fully believe him that he had zero inventory on 12/31, but I know he had very little. And kind of going forward next month, I really want to get inventory right and everything. But for the purposes of wrapping up 2019 in a quick and easy way, would the best thing for me to do? I mean, besides a journal entry, I mean, I want to go further than that and actually make an inventory adjustment.
Yeah, you can't do a
Would I
journal
make a
entry on inventory. You can't debit or credit the inventory asset account in a regular journal entry. You'll actually create a permanent difference. So, because when you're adjusting inventory, it has to go through the items. Otherwise, you're going to leave a permanent difference in those items, and you're going to be sort of falsely adjusting the inventory asset account. In other words, and the shocking thing is sometimes I go through a client's books and I see entries their CPA made where they did create a regular journal entry and they debited the inventory asset account directly. And I realize it's because they're just trying to adjust the balance sheet. They're not thinking about the mechanics underneath the surface. But the moral of the story is you can never just adjust the inventory asset account. It has to go through the items. Otherwise, you're going to cause permanent differences that will never resolve themselves.
And it's the best way to do that just with the inventory quantity, adjustment that we were
It's the
doing.
only way. So you would take a report like the inventory valuation summary here, right? Back to the summary report. So, and you would run this as of, let's say, December 31st or whatever it is. And then in another tab, you'd open up the inventory adjustment screen and you would just, whatever's in here, you would zero it out, right? So if I was doing this to zero it out, let's just use this other tab. Inventory quantity adjustment. Okay, the first thing I would do is list each of the products that I know I need to adjust. So I've got a pump and a rock fountain. And a rock fountain. And then sprinkler heads and sprinkler pipes, right? So that's all we got.
And I've got a whole bunch of negative quantities in here.
So you're just going to zero them out. Doesn't matter. It just means they sold inventory. They recorded sales of inventory that they didn't account for in terms of the purchases, right? That's very, very common. But look how easy this is now. I just need to zero these out. I don't care if they're positive or negative. I'm in the new quantity column. I'm on the first row. And I'm going to get one finger on the zero on my keyboard and another finger on the down arrow. And done. That's it. You literally just zero out the new quantity so that's going to become the new quantity of zero. Again, what happens if you have negative quantities, it means we recorded more sales than purchases for that item. If we did that, it means we've likely understated cost of goods sold, because if we were missing the purchases, then the inventory value was understated, which means whatever got transferred to cost of goods sold for that inventory was also understated. So when I make this adjustment and I bring those negative quantities up to zero, and I'm offsetting a cost of goods sold account when I'm doing that, I'm increasing the inventory asset account, to get it to zero because it was negative, and I'm actually decreasing cost of goods sold. I think I said that backwards. When a cost of goods sold gets overstated when I sell more than what I bought, and this brings it back into balance. Got it?
Okay, so I literally, it doesn't even matter if it's positive or negative. I literally
Nope.
just create new quantity and it takes care of itself.
Because in reality, here's what usually happens that causes it to go negative. Either I didn't enter all my purchases, and again, this is going to fix that because I'm pushing it all through cost of goods sold. So what I was lacking by missing the purchases was not getting into cost of goods sold in the right amount. Now we're adjusting for it accordingly. The other thing that often happens is I sell an item, I produce an invoice in QuickBooks, and I pick the wrong SKU. So now what I've done is I've deducted one too many of the wrong SKU that I've chosen, and I didn't deduct one from the one that I should have chosen. So one is overstated, the other one's understated. When I zero them both out here, because one's going to have one too many, one's going to have -1. When I zero those out, it fixes that, right? That's the beauty of this, is that the one surefire way to clean inventory is to count it and just agree. Because the one thing we can rely on is what somebody physically went in the warehouse and confirmed. This is what we have on hand. This is what it costs. And we're going to adjust it to agree to that. If your guy is basically saying, hey, we had no inventory as of December, that means that if anything was recorded to inventory, we were understating cost of goods sold, overstating inventory. By zeroing out the inventory, we're now going to reduce the inventory down to zero, which it should be in that case, and everything else has to go to cost of goods sold. So now cost of goods sold will no longer be understated, right? We're raising up, we're adjusting the inventory that he did have on hand down to zero, and again, running that through cost of goods sold. What it effectively means is everything he purchased, whatever he started with plus everything he purchased, all got sold. That's basically what he's telling you. And that at the end of the year, he had nothing left in the warehouse.
And I think that's accurate. So I think doing a 1231 entry of this zero and everything out will take care of itself. And then, correct me if I'm wrong, but it seems like, and I've already told him, like, we're going to have an inventory, just hire somebody to do that. Mm-hmm. Just get that number next month or whenever and just tie to that, right?
Yep. Yeah, as soon as he counts it, you post another inventory adjustment dated on the day of the count, and you enter in the quantities for each of the SKUs. So if they come back afterwards and they count it and say, well, here's what we have now, maybe this one's going to be 23 and this one's going to be 10, and whatever it is, you just put the new quantities in and it'll adjust it accordingly.
Nice.
Right? But whenever you post one of these, you always want to go back and check your valuation summaries to make sure that nothing has a value that's like way out of whack.
Yeah, I think in mine, there's a bunch of them had zero values. I don't know what that would be about.
Right. Well, so if you find something like that, you can do what I did here, where I went through it with the pump, where you do the $0 bill. It's got two line items. The first one zeroed out its value, and the second one put it back on the books at the value that we wanted, right?
Mm.
We subtracted the 250 out of the value, and then we added it back in based on $15 a piece instead of 10 to get the $375 valuation that we really wanted. So
and that's because you found out that, like, the $15 was the accurate amount.
Yeah, it could be that, when somebody entered the previous bills, they were entering them at $10 per unit was what was remembered, and maybe the supplier had actually raised the prices, and it opens up a can of worms, really, because if that were a real scenario, then the question is, the vendor must be pissed off at us now because we've underpaid them, right? At some point, you would think they would let you know, but who knows? You see all kinds of stuff happen with these things. But it also could be that you've determined that you want to absorb, let's say, other costs into the cost of this inventory. Maybe they have some logistics costs, right? So if that were the case, if those logistics costs were booked to some other cost of goods sold account, then what you would do is up here to account for the difference, instead of inventory adjustments, you would use whatever the logistics cost of goods sold account is. Because basically that's what you're doing, is you're taking cost out of the logistics cost of goods sold account and absorbing it into the new inventory valuation that you're pushing here. So again, and this is, if for somebody who's inventory illiterate, this is like very advanced stuff that we're talking about here.
And when is logistics COGS and when is it not? Is it freight in? Is COGS, freight out's not?
Always, yeah.
Got it.
And just to be very specific about that, if it's freight out from one of our warehouses to another, that's still cost of goods sold, right? Where cost of goods sold stops and overhead begins is when the product has already been sold and I'm now shipping it to my customer. That's when it's no longer cost of goods sold. Because cost of goods sold is defined as the cost necessary to get the items ready for sale. When I'm shipping it to my customer, the sale has already taken place. They've already gotten ready for sale. Now I'm selling them. That shipping cost is not cost of goods sold. Now keep in mind, we're using a very strict GAAP definition of COGS there. That's what public companies have to do. A lot of small businesses are, and frankly can, if they want to, ignore that, and they can put all their shipping in COGS if that's just how they want to see it show up on the P&L. But true GAAP, generally accepted accounting principles, true GAAP accounting, freight out to the customer is no longer cost of goods sold.
What about software integrations? Like my client he was using QuickBooks last year for like, I don't know, 7 of the 12 months. I don't know what the heck they were doing the other 5 months. But now they're using TradeGecko, which has, I think,
I had to look at that recently. It looked pretty good.
Anywhere 1 to 3. And is it just like is there anything to be aware of, like with that software integration and how it integrates with
any
QuickBooks
software
and
you're
what
using,
can go wrong?
especially if it's managing inventory, you want to check that you're getting the right inventory asset after it's posted something and that you're getting the right cost of goods sold number, right? That's how you check an inventory app is, am I getting, ultimately, it's all about what's the right inventory valuation. If you get the inventory valuation right, cost of goods sold is going to take care of itself, right? Because that's just the offset to whatever happened in inventory. So again, when you're looking at any apps, does it have a good user experience? Is it easy for the client to use? That's one test. What kind of companies behind the app? Are they going to be around in 5 years, or are we going to be looking for a replacement soon because it's a poorly managed company? You always want to look at that aspect in any app that you're using. And then ultimately, does it get the accounting job done right? A lot of times these apps are developed by developers and not accountants. And they may understand the logistics side of inventory, but they don't necessarily understand the accounting. And so you end up figuring out that you have to make all kinds of adjustments on the back end to get it right. Obviously, if you have to do that, that's not an app you want to use, right?
And are there some apps that, if it's like other things I've dealt with, some integrate with QuickBooks great, and then others don't integrate terribly, where it's almost just better to not even do it in QuickBooks and really just handle it in the other software?
Yeah, I mean, that's obviously case by case that you have to evaluate. The other thing is, and this is sometimes a very legitimate decision, is maybe you don't want to track all the inventory details in QBO, which means you're going to do what's called a periodic inventory system instead of what's called perpetual. Perpetual inventory system is what we're accustomed to thinking about normally, where I have a purchase order, let's say, I can turn that purchase order into a bill. Once I enter it as a bill, it increases my inventory. Then I sell it and it decreases my inventory, right? That's perpetual. Every time I record a transaction, inventory is updated in QuickBooks Online. Periodic is what we do, and we have some other system that we rely on to track all the inventory. And then what we do is once a month, we pull the data out of that system. We say, okay, other system, what's my inventory valuation as of April 30th of this year? And it spits out and says, your inventory valuation is $90,000. Well, we look at our inventory and it says that the inventory is 95. So we make an adjustment and we credit the inventory asset for, this is when you can or do make an adjustment directly to inventory without going through the items, because you're specifically not tracking it by item in QuickBooks Online. So then you would credit inventory and debit cost of goods sold. You credit or debit inventory depending which direction it needs to go. And the offset, it goes to cost of goods sold, because in the interim, you're booking all of your purchases straight to cost of goods sold. right? So when you get that inventory number out of the system, then you're basically saying, here's the right inventory number. And the adjustment, the offset has to be the cost of goods sold, because either too many of our purchases went to cost of goods sold or we're not enough. And so either way, we're adjusting it accordingly.
Yeah, I've only done periodic, so the whole perpetual right way is what I'm very illiterate in.
Yeah.
But that's fine.
Yeah, but it's important to understand, because even if you're doing perpetual, you need to understand that the system you're relying on, even if you're doing periodic, the system you're relying on is perpetual. And you need to really understand the process to make sure that system is getting you the right information, right? And there can be all kinds of variables. You know, with one client I had, we were just really racking our brains trying to figure out an efficient system for tracking his logistics costs and absorbing that into the cost of the inventory. Problem is, logistics costs are usually based on weight. And he would get that information on the bill from the logistics company. Would say, okay, we shipped so many pallets, and here are the different products that were on that pallet, and here's the weight of each. And it would break it down, but that still meant that we had to somehow go through every bill from his logistics company and then create an inventory adjustment, deducting the costs out of the logistics WIP account, which is what we would call it. We would initially book the payments that went to the logistics company to an asset account called logistics WIP, or work in process. And then we would have to take money out of there and absorb it into the cost of the inventory. And there was just no practical way to do it. We played around with lots of different scenarios, and there's no way to do it practically. There are some apps that will do it. I've been looking very closely at an app called Margin Driver, which is an e-commerce app. And I haven't had a close enough look to confirm it yet, but this is what I mean. We want to be able to understand this stuff well enough that if the app says, yeah, we're calculating the inventory valuation, you want to be able to calculate it yourself and make sure you can get the same number that the app does. And if you can't, either you have to better your understanding of what's going on, or you have to know it so well that you can prove why the app is doing something wrong. And that's not always hard to do, because you have to be able to prove that in such a definitive way that you can actually convince the person whose baby you're about to call ugly, right? And show them, hey, this is a problem with your app. They're not going to be inclined to want to admit that, right? Most of them are very proud of their work. Some of them should be. Some of them maybe shouldn't be. So anyway, that's my story, and I'm sticking to it. And we're at the end of the hour. So I will get this recording posted up as soon as possible. And we'll have another good topic next week. I just don't know what it is yet.
And will the inventory, I know it was super basic, but are you going to include that inventory spreadsheet in there?
For an extra $5,000, Jesse, you can have my
Sweet.
Yeah, of course, I'll post the link up with the recording to the spreadsheet and the little Google sheet that I did, so you can play around.
Awesome. Thank you so much.
All right, you're very welcome. I'll see you on the other side. We'll see you Friday. I forgot what the topic is, but we do have one, and I'm sure it's really good. I just don't remember what it is. Bye.